All right, welcome to the Explainer. Today, we are cracking the code on something that can feel super complicated. Non-qualified stock options, or NQSOs. If you've ever gotten these from your job, you know it feels like you've been handed a puzzle. Well, our goal today is to give you the map to solve it. You know that feeling, right? You get granted stock options, and there's this initial rush of excitement, which is almost immediately followed by a wave of, what does this actually mean? It's a totally common feeling, and it almost always leads to one very specific question. And there it is. That's the big one. This is the fear that paralyzes people. Are you really getting taxed on the same money 2 different times? Stick with me, because by the time we're done here, you're going to have a crystal clear answer to that exact question.
Okay, let's dive right in. Before we can even touch the tax question, we have to build a really solid foundation. We're going to start from square one. What even is a stock option?
So the most important thing to get is right there in the name. It's an option. It's not the stock itself, not yet anyway. Think of it like your company giving you a special coupon. This coupon lets you buy their stock at a locked-in price, what we call the exercise price. If the stock's actual price on the market goes up, your coupon gets way more valuable because you can still buy at that old lower price.
Every single stock option follows the same predictable journey. There's a clear path from the day you get it to the day you actually own the shares. We're going to use these 5 steps as our roadmap to see exactly where and when the taxes kick in. Okay, let's get right to the good stuff. With NQSOs, the tax story has 2 main parts, 2 completely separate moments when you get taxed. And the very first one happens the second you decide to use that coupon, the moment you exercise your options to buy the shares. So let's really zero in on that first event, the exercise. This is where your first tax bill comes from, and it's the one that catches so many people off guard. Why? Because you haven't sold a thing. No cash has hit your bank account yet. The IRS has a special name for that discount you got with your coupon. They call it the bargain element. It's simply the gap between what the stock is actually worth and the lower price you paid for it. Now here's the kicker. The government doesn't see this as an investment gain. They see it as compensation, just like your salary. And that means it gets taxed just like your salary, at your regular, ordinary income tax rates. And this right here, this is what's known as phantom income. Let's say you exercised 1,000 options and got a $3 per share discount. Boom. Even if you hold on to every single one of those shares, you've just created $3,000 of taxable income that the IRS expects you to pay taxes on. It'll even show up on your W-2 that year.
All right, let's move on to the second tax event. Now, this one is probably a little more familiar to you if you've ever invested. It only happens if and when you decide to actually sell the shares you now own.
Okay, listen up, because this is one of the most common and most costly mistakes people make. You know that 1-year clock that determines whether you pay short-term or long-term capital gains tax? Well, with NQSOs, that clock does not start when you get the options. It doesn't start when they vest. The clock only starts ticking the very day you officially buy the stock, your exercise date. So why does that 1-year clock matter so much? It's simple. Money. It's the difference between paying taxes at your high ordinary income rate versus the much friendlier long-term capital gains rate. Just by holding your shares for 1 year and 1 day after you exercise, you could significantly change how much of your profit you actually get to keep. So let's circle all the way back to our original question. Are you taxed twice? Yes. But as this Reddit user puts it so perfectly, it's on 2 totally separate and unrelated amounts of money. You're taxed once on that initial bargain when you buy the shares, and you're taxed a second time only on the new growth, the profit you make between when you buy and when you sell. 2 different profits, 2 different taxes. So now that you get the tax rolls, you can see that exercising your options isn't just a simple transaction. It's a strategic choice. You've got a few different ways you can play it, depending on what your financial goals are. This table lays out your 3 main moves. First, exercise and hold. You pay for the shares and the taxes with your own cash, hoping the stock goes up. Second, exercise and sell. This is a cashless move where you immediately sell everything to just walk away with the profit in cash. And third, sell to cover, which is a really popular hybrid. You sell just enough shares to cover the costs and the taxes, and you hang on to the rest. Look, understanding the rules is half the battle. Now let's talk about the traps. Let's cover the common and sometimes really painful mistakes that people make with their NQSOs. This is the absolute nightmare scenario. It's the one you really have to watch out for. Imagine this. You exercise when the stock is flying high at $50 a share, locking in a huge tax bill based on that value. But then the market turns, and the stock drops to $20 before you sell. That profit you were taxed on, it's gone. But that tax bill, oh, that's still very, very real.
And that nightmare scenario leads to this completely absurd situation. You could owe the IRS thousands of dollars for that phantom income, but have zero cash from the stock to pay the bill. And that's exactly how people end up in the unbelievable position of having to borrow money just to pay their taxes. And beyond that big risk, keep these other things on your radar. Always, always double-check your tax forms. Brokers can and do make mistakes on your cost basis. Don't assume the taxes your employer withholds will be enough. It's often way too low. And if you work for a private company or a startup, you absolutely have to ask if you can exercise early. It can be a game-changing strategy for saving on taxes down the road. Okay, so let's boil it all down one last time. If you walk away remembering just one thing, make it this. NQSOs have two separate tax events. First, you pay ordinary income tax on that built-in profit the moment you exercise. Second, you pay capital gains tax on any new profit when you eventually sell. And that all-important capital gains clock starts ticking on your exercise date.
So with all this, the puzzle doesn't seem quite so intimidating anymore, does it? You have the map, you understand the rules, you see the traps, and you know the opportunities. The only question left is, how are you going to use this knowledge to help your own financial future? What's your first move?